Today I'll be going over my top 5 dividend stock picks for 2026, and I didn't just choose stocks that have the highest starting dividend yield. I chose companies with the highest moats in the world, some of the best business models, and those moats are going in the right direction over the next several years in my opinion. And these are companies with low payout ratios while also increasing their revenue and margins very quickly so they can continue to healthily increase their dividends over the next many years as well. So getting right into it, stock number 1 is Mastercard. Now they don't have a very high starting yield, around 0.61%, but they're growing their dividend very quickly, and they maintain a very healthy payout ratio of around 18%. And I know that's a pretty low yield, starting yield, so that might be a turnoff to some dividend investors. But keep in mind, they're growing their dividend very quickly, they're growing top line very quickly, and their margins are expanding. And Mastercard is one of the safest companies in the world, one of the highest moat companies in the world, and their moat is only going to increase in my opinion. And it could be tempting to go into just stocks with, the highest dividend yields you could find, but a lot of time these companies can be traps. Not all of them. You could find high dividend yielding stocks that are good companies that will continue to grow that dividend. But when you find a company that's 3.5, 4+% dividend yield, a lot of the time their payout ratios are incredibly high. I'm talking 90+%. And you really got to be careful with those stocks, because if they have any hits to their revenue or their margins, then they may even have to go into debt to continue to pay out that dividend that they basically need to pay out. And at that point, they also won't have any money to reinvest back into the business. All their cash flow is just going straight into dividends. That is not healthy. You will see stock price depreciation in that scenario. And it does not matter how high of a dividend yield you have. If you get into a stock with stock price depreciation over a several year period, best case, you'll be around flat on the stock. Worst case, you'll be down a lot on the stock. So I believe it's way more important to get into companies, even if they have lower dividend starting yields, they can healthily increase that dividend over the next several years. And Mastercard has very healthy revenue growth. I wouldn't even just say healthy. This isn't just some stable, good growing business, mature business. This is a growth business still. They've accelerated to 16% revenue growth on a trailing 12-month basis. And this is still accelerating. Earnings per share even faster, growing at 19%. This is due to their, again, margin expansion. And they're also doing substantial share buybacks. They've decreased their share count around 2+% over the past decade, year after year, just taking off shares off the market, bringing substantial value back to the shareholder. And in my opinion, share buybacks are a great complement to a dividend as well. They are both direct value given back to the shareholder. And they're trading cheap. They have a 31 trailing PE, a 26 forward, around a 3.7% free cash flow yield. Now that might not seem super low, but this is very cheap historically speaking for Mastercard. In fact, this is the cheapest their price to earnings has been at all over the past 5 years besides 2022. Besides the huge market sell-off, the huge bear market we had in 2022, this is literally the cheapest you could have buy Mastercard for any price over the last 5 years. And not just on a price to earnings valuation, free cash flow yield as well. Again, besides 2022, which it was pretty close to right now, and a higher yield means the company's cheaper. This is the second cheapest you could have gotten Mastercard at any point by far over the past 5 years. And this company is only strengthening in my opinion. Their revenue is accelerating, their margins are expanding. They have 2 main businesses. They have their payment network and they have their value-added services segment. Their payment network still growing at a very nice 12% clip. But part of the real bull thesis, in my opinion, is their value-added services segment, which is growing 23% right now. And this business is higher margin than their payment network business. So their fastest growth business is also higher margin. So that's just going to continue to increase their overall margins over the next several years. And value-added services is a very vague term, so I'll cover that real quick. Part of their value-added services segment, Mastercard sells cybersecurity services, they sell data analytics and consulting services to businesses. Basically, in one of the smartest ways possible, Mastercard is leveraging the fact that they have some of the best data in the world, if not the best data in the world, on consumer spending habits. They know exactly how much you spent, where you spent it. They know your exact spending habits. They have that data. And with that data, they can sell analytics and consulting services to these companies to help them better target and understand their audience better. So it's an incredibly smart way to leverage your data, and this can't just be replicated. So this is an incredibly useful product to companies, and I expect this business to just continue to grow at a very high rate over the next several years as well. So getting into my projections for the stock, analyst estimates have them at around a 17% free cash flow per share growth CAGR over the next 5 years. So slightly conservative, I went right under that at about a 16% free cash flow per share growth rate. And I gave them a free cash flow yield of around 3%, which is still fairly cheap for Mastercard. They usually trade below that at around 2 to 2.5%. But again, I like to be slightly conservative for my cases. And in this scenario, we get around a 20% CAGR in the stock, leaving the stock price around 1.33K in 2031. So you get very good, very high market-beating returns while also getting a dividend that's increasing around 15%. This, in my opinion, is a lot more attractive than just a very high starting yield stock that has minimal, if any, share price appreciation. But going into stock number 2, that is going to be Microsoft. Microsoft has been getting just sold off extreme over the past 6 months, and this is very rare for Microsoft. Microsoft is very much known as just one of those stocks. They're known as one of the most stable, predictable, and less volatile tech companies, and especially of the Mag 7. Historically, they've been known as this. So trade-offs this extreme and sharp is very rare for Microsoft. But this is happening because of 2 reasons. There's just been a huge sell-off towards any software name company. And of course, Microsoft software suite, Office 365, falls under that category. So they've been selling off because of that. They've also been selling off because of their CapEx. All companies that are spending insane on CapEx right now as well, like Google, Amazon, they're all selling off. So they're kind of getting hit with a double whammy right now. They're selling off because of their CapEx spend, because of fears over that, and they're selling off because of their whole software suite and the fears around AI eating software as well. Now, we haven't seen AI eat into Microsoft or a lot of software companies' revenue or margins at all yet. All these fears and sell-offs are in a way unjustified, at least in terms of numbers, because we have not seen in Microsoft or most big software names, we have not seen these companies get hit from AI eating into their market. All these fears are about the future. They're about what might happen. So it's kind of a judgment call whether you believe software will just get completely disrupted by AI or not. In my opinion, I think AI will just be a net beneficiary to the best software companies in the world. I do believe there are a decent amount of non-critical software that will get disrupted a decent amount. But I believe, and these companies have shown it, that incorporating AI into their software products only increases stickiness, only increases spending from these companies that use their software, and again, just increases the hold that these software companies have over their customers. And jumping over to Microsoft's revenue growth, they're growing 16% in the past year, and this is also accelerating right now. And I mean, a company of Microsoft size growing 16% is still very impressive. $305 billion in revenue over the past 12 months. And yeah, due to this sell-off, they're trading cheap right now. Very cheap historically for Microsoft. We almost never see them at valuations like this. Now, their PE ratios look a little cheaper than they actually are right now because of a one-time accounting gain that Microsoft had on their net income last quarter due to their OpenAI stake. But you take away that accounting gain, and on a non-GAAP basis, their trailing PEs around 26 right now, and their forward P's around 24. So just slightly higher. It's still very cheap though. We typically see Microsoft in the 30 to 35 PE ratio range. So in the mid to low 20s is definitely cheap for Microsoft historically. And they have a dividend yield of 0.85%, so a bit higher than Mastercard as well, with a payout ratio, a very healthy one of 21%. And they have consistently grown their dividend 10% a year for the past decade. So you can just expect high dividend growth from this company for many years to go still. So getting into my projections, the average analyst estimate for EPS growth over the next 5 years is around 14%, 14.2%. So I just went around 14%. I believe they can do that. And I gave them a PE of 30, which is still historically cheap for Microsoft, as I would say they average around 35. But there's also the possibility that because of AI, there might be a permanent multiple compression on Microsoft. But however, I do believe they heavily oversold. So they could easily, I do believe they'll go back to eventually a PE of around 30. So with EPS growth of 14% and a 30 PE multiple, we get a 15% return on the stock, leaving the stock price around $800 in 2031. So very good market-beating returns in a safe company that will continue to increase their dividends. But getting into stock number 3, we have American Express. I could make a full video on American Express, but I'll try to keep this short. American Express appeals to the top 10 to 20% of income earners, and they've been very successful at establishing their brand as just the most premium and popular credit card brand for wealthy individuals. And there are so many benefits of appealing to, I should say, successfully appealing to wealthy individuals and successfully taking that market. Because of that, compared to other credit card companies and banks, Amex doesn't make their money from interest rates. They're a subscription company. They make their money from subscriptions. The top 10% of earners are not missing credit card payments. They're not carrying over balances on their credit cards. They pay off their credit cards immediately. So Amex does not make the vast majority of their money from their customers paying those high interest rates. They make it from the very high annual fees that they have on their credit cards. And this also greatly protects American Express during recessions, because not only are higher income earners more likely to continue spending during a recession than lower income earners, but Amex can support a higher multiple on the stock because of how much safer they are during recessions and times of less spending. And if you look at their revenue growth, they're clearly showing the signs of a more maturing company. Their revenue growth is definitely decelerating and leveling out. However, they're still growing high single digits, and I expect this revenue growth to stay in the high single digits, or maybe even possibly accelerate to low double digits. If you look at their earnings per share, it's growing even faster, and it's accelerating. This is primarily due to their very large amount of share buybacks that they do. I mean, look at this share count. Over the past 10 years, they've reduced their share count on average around 3.5% a year. That is so much value given to the shareholder over time. Incredibly impressive from Amex. You look at their dividend growth. The only time it stagnated was right after COVID, and they didn't bring it down. They just flatlined the growth for a couple quarters. But over the past several years, they've gone back to increasing it at a very high rate. They increased it 17% year over year, and their yield sits at about 1% right now. Again, another healthy payout ratio of around 21%. And their valuation's cheap. Trade at a 22 trailing PE, a 19 forward, almost 7% free cash flow yield. And yeah, they're not going to command the multiple of, say, Mastercard or Microsoft. But again, there's a lot less risk with Amex compared to other credit card companies and banks due to their business model and their target audience. So they can command a higher multiple than their industry. And if we look at analyst estimates, they estimate around a 14% 5-year EPS CAGR. So again, I went slightly below that at 13%, and I gave them slight multiple expansion at a 23 PE. And with these assumptions, you get a 14% return in the stock, leaving the stock price around $652 in 2031. So you're getting a very safe company, you're getting market-beating returns, and they're just going to continue to grow their dividend for many years still at a very high rate. I mean, they grew at 17% year over year. But now we will get into stock number 4. That is Intuit. Now, again, if you believe of the mindset that all software is just at great risk right now, and you are just so uncertain of whether AI will eat into them, then you shouldn't invest in Intuit. I believe you should invest in companies you have clear convictions in and companies that you understand. However, in my opinion, I do not believe Intuit's business model will get disrupted by AI. TurboTax, QuickBooks especially, these are just such important products to medium and small businesses. I do not believe AI will disrupt those products. TurboTax has had incredible competition for years. Competition is nothing new to TurboTax. And I feel like a common belief around all software right now, I feel like the thought process is that these companies are just waiting at any opportunity to just dump these softwares and just to try to find any other option, which does not make sense. These companies love the software that they're paying for. If they didn't, they wouldn't pay for it right now, and they wouldn't have these incredibly high renewal rates. I mean, even going beyond Intuit right now, but we have ServiceNow, Adobe, Salesforce, but we'll also throw in like QuickBooks. These companies love these products. They save these companies hundreds of thousands of employee hours. The efficiency gains that these softwares provide these companies are so valuable, and that is why these companies continue to pay for these softwares. People have this belief that these companies are just looking at any opportunity to jump out of these software companies to, I don't know, go into some vibe-coded software, I guess. But these companies they aren't just incredible software that makes these companies a lot more efficient. That's not all there is to it. It's not just the software. It's also the trust that these companies have built over decades working with the largest companies in the world, being integrated with the largest companies in the world for decades. You can't build that trust. An AI startup can't build that trust overnight with some vibe-coded software. And if these companies just ditched all their softwares that they pay for, like QuickBooks or ServiceNow or Salesforce, if they just ditch those, I mean, transferring their data and workflows to any other software would just be a nightmare. Companies don't want to do that. They want to focus on their product. They don't want to lose all those efficiency gains and have to put all that focus on simply getting reacquainted or acquainted with a new software. Companies want to work with the industry standard, and they want to work with what's trustworthy and works very well. And that is what Intuit does with QuickBooks and MailChimp. That's what ServiceNow does. That's what Salesforce does. That's what Adobe does. And QuickBooks, their target audience is more so medium to small businesses, while like ServiceNow, Adobe, Salesforce, they a little more so target larger businesses. But also, what I don't get about the Intuit sell-off is people are saying AI startups are just going to disrupt all these big software names that appeal to these large businesses. But if there's a bunch of new AI startups that are very successful and just a ton of healthy startup companies throughout the US, that would be a net positive for QuickBooks. QuickBooks appeals to small and medium businesses. These AI businesses aren't just going to build their own AI software for bookkeeping and payroll management. They're not going to do that. They're going to use the industry standard. They're going to use what works best and what is trustworthy, and that's QuickBooks. So if anything, if a bunch of new AI startups just start disrupting everyone and there's a huge wave of successful small businesses, that is a net positive for QuickBooks. But going over to their revenue, they grew revenue 17% year over year. Analysts do estimate that their revenue may decelerate to around 13%. But for one, we have yet to see that. Two, I don't believe this company, at least not in the next 5 years, will ever decelerate below 11% revenue growth. And look at their earnings per share, how fast they're growing that. They grew that 42% year over year. This company is selling off so insane, but they are growing their revenue very quickly still, while increasing their bottom line even faster. They have a dividend yield of around 1.12% right now. And again, still pay a little bit of a higher ratio, but still very healthy payout ratio of 30%. And they're trading around a 27 PE right now and a 16 forward PE. And that is so historically cheap for Intuit, it's insane. If you look how fast they're growing their dividend, they've consistently for the past decade grown their dividend at a 15% clip. 15% dividend growth rate every single year for the past decade. That is incredibly impressive. And look how cheap they are right now. Over the past 5 years, Intuit's average PE has been around 55, while they're trading at a 27 right now. I mean, their PE has fallen off a cliff. They're about half of their historical value, well below their 2022 lows. So now to my projections, the average analyst estimates for EPS growth is around 13 to 14%. So I went slightly conservative, around 13% growth. and I gave them a PE multiple of 35. Now, I don't actually believe they'll ever go back to their historical average of a 55 PE. They might have permanent multiple compression. However, what they're trading at now is way too low. They should not be trading at a 27 and a 16 forward. That is too low for this company, and I believe they could easily go back to at least a 35 PE multiple. So with these assumptions, you'll get a nice 18% return on the stock, leaving the stock price around $943 in 2031. An 18% return on a stock price every year with a 15% growing dividend, and one of the safest software companies in the world. I mean, this sell-off is just so overdone, it's insane. But moving on to stock number 5, which actually is not a stock, we have SCHD. SCHD is a ETF, and they track the Dow Jones US Dividend Index 100. Now, I'm not going to go over their whole methodology, but basically, in my opinion, they are the highest quality dividend ETF. I really like the screening process they put stocks through and how they rank them. And again, these aren't people choosing the stocks. It is purely the algorithm that they have established. And SCHD has been around since 2011, and they've grown in line or even faster than the S&P 500 through certain periods. So you get very good, or at least decent, share price appreciation with a high dividend yield. And here's just some of their top holdings. You know, you have the most popular dividend stocks like Lockheed Martin, Pepsi, Coca-Cola, Home Depot. So this is just a much more diversified and stable dividend holding than those individual stocks I gave. Now, there's a big worry around SCHD last year that the methodology that they use to pick stocks is broken, and that SCHD is a fund that no longer works. When you look at those April lows, that huge steep fall off that we had in SCHD, most stocks from that fall off point, or not most stocks, growth stocks and tech and Mag 7, they had huge V-shaped recoveries that just rocketed straight up from there, while SCHD just kind of trudged along. They went slowly climbed, but they were kind of just trudging. Then for another couple months, they went down a bit, then kind of went back to even, just kangarooing a little bit. Still not even reaching their pre-April highs yet. But we see in the last month, once we saw this rotation out of tech and growth stocks and SaaS companies into the rest of the S&P 500, we're starting to see SCHD just skyrocket. They're up 13% now in the past year. A dividend ETF is up 13% in a year. And just year to date in the past month, I believe they're up around 12 to 13%. And they pay a high dividend yield, especially comparatively to the all stocks I just talked about. Their starting yield is around 3.31% right now. And they grow that dividend at a very high rate. They've grown it around 10% over the last 10 years. So a starting yield of 3.31% that's growing roughly 10% a year is very intriguing. Now, for a pure dividend investor, this SCHD might seem like a better option than all the other stocks I just talked about. However, though SCHD is a lot safer, has a higher starting dividend yield than all the stocks I just mentioned, the potential stock price appreciation is severely capped compared to all the stocks I just talked about. Again, all those stocks are much higher risk as they're individual stocks, and SCHD is a fund of 100 companies. There is a lot more growth potential with the individual stocks. So it's really just about your preferred risk reward. If you like taking on a little more risk, then individual stocks is probably the way to go. But if you prefer more immediate dividend income, while also wanting to be in a more safer asset that also at least has stock price appreciation as well, even if it's more capped, then SCHD is the better move there. So whether you want to be in a dividend fund or dividend stocks, there is no right or wrong answer. It is just based on your risk threshold and which one you feel safer at night investing in. So I'm going to end this video here. Let me know down in the comments whether you agree or disagree with my dividend picks. Again, I prioritize dividend stocks that can grow their share price at a high rate as well to increase overall returns, but also have an increasing dividend as well. But I thank you all so much for watching this video, and I will see you all in the next one.